Do you have an interest in accumulating wealth and achieving financial independence over time? If this is the case, you may be familiar with the term snowball effect as it relates to the process of paying off debt. Did you know, however, that the same idea can be applied to the process of accumulating wealth through dividend investing? It is a strong strategy to develop your portfolio and provide a consistent stream of passive income, and it has a name: the dividend snowball effect. You may harness the magic of compounding interest and watch your wealth expand tremendously over time if you consistently reinvest any dividends that you get from your investments. In this sense, the dividend snowball effect might be an important technique for accomplishing your long-term monetary objectives. You are familiar with the outcome that results from rolling a little snowball down a slope. When it reaches the bottom of the hill, it transforms into a monstrous snowball since it has been continuously gathering snow. As it travels down the slope, the snowball gathers more snow into itself. Compounding can be thought of as an analog to the snowball effect. It illustrates how relatively insignificant acts can lead to significantly significant results over time. What does it mean to snowball dividends? A continuous cycle of increasing dividend income is referred to as a dividend snowball. The formation of this capital takes place through the purchase of shares in dividend growth stocks. The dividend income received from those shares grows over time as they are held. The infusion of fresh capital, the practice of dividend reinvestment, and organic dividend growth all contribute to an increase in dividend earnings. How exactly can one benefit from the snowball effect of dividends? The process of the dividend snowball effect is extremely straightforward. When the corporation makes a payment toward its dividend, it also makes an automatic purchase of additional shares of stock. Taking this step will result in an increase in the dividend payment that is sent to you in the future. Your shares and dividend payout will both increase at an exponential rate as the cycle continues. This will create a snowball effect that will continue to compound over the course of your investment's lifetime. An investor might potentially amass more shares of a stock by investing in dividend-paying stocks and then reinvesting the dividends received from those stocks. This in turn results in the generation of further dividends. This results in a positive cycle in which the growth of the dividends accelerates with time, similar to how a snowball would roll downhill if it were given enough time. The effect is more obvious in corporations that raise their dividend payments over the course of time, as the investor gains not only from an increased dividend payout, but also from a greater stock price. The effect of compounding, which occurs when dividends are reinvested over a long period of time, can result in considerable returns, frequently exceeding those obtained from equities that do not pay dividends. The fact that the dividend snowball effect calls for a patient and long-term outlook is one of the most important factors that contribute to its success. When an investor keeps reinvesting dividends, the total number of shares they hold continues to grow, which results in the effect being more potent as time goes on. Because of this, the value of the investment may substantially rise over the course of time. Investors should search for companies that have a history of steady dividend payouts and a track record of growing those payouts over the course of time. This will allow them to take advantage of the dividend snowball effect. These businesses have a tendency to be more stable and less volatile than others, making them an appealing option for investors that have a focus on the long term. In addition, investors ought to give some thought to making use of a tax-advantaged account, such as a Roth IRA or 401k, in order to lessen the financial impact that is caused by dividend payments. Developing a dividend snowball strategy involves the following steps. Only strong dividend growth firms with a proven track record of annual dividend increases should be considered for investment by prospective buyers. You have the choice of making your selection from either the list of the dividend kings or the list of the dividend aristocrats. Check to see that the payout ratio does not get higher than 75% at any point in the process. If the payout is reduced, there is a better chance that the company will increase the amount of dividends it pays out in the future. Contribute a set amount each month toward the purchase of more shares so that you can ensure that your monthly dividend payments are sufficient. In order to win this dividend snowball competition, you need to demonstrate consistency. The process of spreading out the expense of an investment over time is known as dollar cost averaging, and it is put into practice whenever it is feasible to buy dividend stocks with the aim of having a steady stream of monthly income. This method will have the impact of reducing the short-term volatility in the overall equities market, which will be beneficial to investors. It is the most efficient approach for a saver or investor to acquire wealth over the course of a period of time, making it the ideal choice for those seeking to do so. Always make sure to buy additional shares of the company using the dividends that you get each month and reinvest the money. By utilizing this method, which has proven to be quite successful, long-term investors can expedite the increase in the number of dividends they get. There are occasions when companies would offer price reductions on merchandise to customers as a promotional strategy. When dividends are reinvested in the company, shareholders are not subject to any additional charges of any kind. The application of this strategy can only result in positive outcomes for investors that hold positions for the long term. When it comes to the growth of your dividends, time and patience are absolutely necessary ingredients. The dividend snowball strategy is an approach to investing that requires some patience on the investor's part. Additionally, due to the gradual growth process, you will need patience in order to be successful with this method of investing in order to achieve success. Advantages: investors that use the dividend snowball effect as part of their investment strategy can reap the rewards of this method in a number of different ways. The following is a list of the most important advantages. Accelerated portfolio growth. Investors can compound their profits by reinvesting dividends, which can lead to increased portfolio growth over the course of time. This type of growth is achieved through the process of compounding. Because of this, investors have a better chance of reaching their monetary objectives more quickly than they would if they did not reinvest the dividends they received. Increased income. It is possible to improve one's income over time by reinvesting dividends in new opportunities. The quantity of income that is generated by the portfolio will expand in line with the growth of the dividend payments that are received. Reduced risk. The dividend snowball effect is one strategy that may be used to assist in decreasing the overall level of risk in a portfolio. Investors are able to purchase additional shares of a company at a lower price if they want to reinvest dividends, which can contribute to a reduction in the cost basis of the portfolio as a whole. This in turn can help lower the risk that the portfolio will suffer a loss. Diversification. The dividend snowball effect is a method that can assist investors in diversifying their holdings, and it is known as diversification. Investors can lower their overall risk exposure by diversifying their holdings across a variety of industries and markets by purchasing dividend-paying equities. Passive income. Investing in dividends can give investors a source of passive income, which they can then use to further their financial goals. Investors can construct a portfolio that produces a consistent stream of income through the practice of reinvesting dividends. This money can be utilized to augment other sources of income or can be reinvested in the investor's portfolio. Inflation protection. Stocks that generate dividends can offer protection against inflation, making them an attractive investment option. It's possible that the dividend payments from these companies will go up as inflation does, which will act as a buffer against the impact of higher prices. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.